Hey everyone, welcome back to another dividend investing video. We're coming up on the end of the first month of 2023 and already 3 of the companies in our public portfolio have announced increases to their dividend payments, giving us shareholders a raise. It is good to be a dividend growth investor getting a pay raise simply for holding quality companies. In today's video, let's go over the 3 companies that just gave me a raise, and I'll briefly cover some of the fundamentals around each and why I'm invested in these companies. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. When I started this portfolio last September, I started off with a selection of 20 stocks that I was just going to dollar cost average to with weekly contributions. The idea was to pick high quality companies that I'm comfortable building up positions slow and steady over the next couple years without trying to time anything. It's somewhat of an experiment in dollar cost averaging that I'm just sharing here on the channel, and we'll see what happens. We have a video coming out at the end of the month summarizing the activity of this portfolio, so make sure you have that notification bell hit so you don't miss that. So let's see how 3 of my picks did for their first dividend increase since I began purchasing them. And stick around till the end of the video. I'm going to share several other companies that recently increased their dividends, so you don't want to miss that. Stock number 1, Comcast ticker CMCSA. On January 26, 2023, Comcast declared its next dividend at 29 cents quarterly. This is a 7.4% increase from the prior dividend of 27 cents. This was music to my ears. Very glad I selected this as one of our stocks. This marks Comcast's 15th consecutive annual increase. Comcast is a media company in the communications sector. They operate cable communications through their Xfinity brand, media networks such as NBC Universal. They have Universal Studios theme parks, and they even own the Philadelphia Flyers NHL hockey team. And the earnings came out on the 26th as well, and really they were a mixed bag. On one hand, they're dealing with a loss of paid TV subscribers, as well as subpar results as they attempt to continue growing their streaming service, Peacock, which is not yet making them any money. But they do have a strong broadband network, over 32 million customers providing steady cash flow, and their revenues are higher than they have ever been. I pointed out Comcast in a video back in October as a stock that was ridiculously cheap, and at the time it was under $30. Today it's sitting around $40, so it has rallied quite a bit over the last quarter. It's up over 26% in the last 3 months alone. I think it's the best performer in our public portfolio right now. However, the stock is still down more than 18% from 1 year ago, so it's still down quite a bit. And I do think at this level the price is closer to what we would expect it to be, though, given some of the challenges Comcast is facing in some of its businesses. Still, it's trading at a PE of 11.2, which is at a 20% discount to the 5-year average PE of 14. Also quite a significant discount to the overall communication sector, trading at a PE of 16.9. The dividend yield is at 2.87%, which is 38% higher than the 5-year average. But man, this was edging close to a 4% only 4 months ago. Still, I think this is a decent value for a company that's committed to growing its dividend payment. And the qualified quarterly dividend payment of 29 cents is paid in the months of January, April, July, and October for a total annual payout of $1.16 per share. You have to have your shares by April 4th to get that next dividend payment on April 26th. The payout ratio is quite low for CMCSA, making up 30% of forward earnings, 32% of forward free cash flow. No real danger here. Simply Safe Dividends gives us a score of 89, and that's rated very safe. We have 15 years of dividend raises now with an average annual dividend growth rate of 13% over the last 5 years. The latest one at 7.4%, I think represents more realistic expectations going forward. Now, shares outstanding are on a steady decline over the last 10 years, with Comcast buying back a good chunk of its shares, going from 5.43 billion shares outstanding in 2012, and today we're at 4.51 billion. The average analyst price target is at $42.54, representing a little over 5% upside from current prices. So while it's come up a bit, I'm still going to be buying Comcast this year in 2023. I still think it's undervalued, just not at the ridiculous level it was a few short months ago. And I think the track record of dividend growth is going to continue, and therefore I will continue building my position. Stock number 2, Chevron Corporation, ticker CVX. On January 5th, Chevron declared a $1.51 per share quarterly dividend, which is a 6.3% increase from its prior dividend of $1.42. This was welcome news, as I was expecting something more in the 4 to 5% range. Additionally, a $75 billion buyback has been authorized. Now, Chevron is a direct successor of the original Standard Oil Company, originally known as Standard Oil Company of California. To me, this is one of those that you just hold, you collect dividends forever, and you never sell, ideally. Chevron, they've been paying an uninterrupted dividend for 110 years. And considering the cyclicality of this sector, that is extraordinary. While the broader market really had a crappy 2022, Chevron is up over 41% in the last year. The energy sector as a whole has outperformed over the last few years. Stocks like Chevron are hovering around their 52-week highs. And as these are cyclical stocks, needless to say, this is likely not the best time to be buying a lot of energy stocks. But I am slowly building up a dollar cost average position in Chevron for dividend income. As for its valuation, CVX is trading at a PE of 11.4, and this is a 22% discount to its 5-year average of 14.7. Also, it's right in line with the energy sector average PE of 10.9. As for the dividend yield, it's at 3.22% at the moment, and this is 20% below its 5-year average. This illustrates just how well Chevron has performed over the last few years as a stock's yield moves inversely to its stock price. Now, Chevron pays out a qualified cash dividend every quarter in the months of March, June, September, and December in the amount of $1.51 per share for a total annual payout of $6.04. To get the next dividend payment, you'll need to have these shares by February 15th, and you will be paid out on March 10th. Chevron's dividend takes up 37% of forward earnings and 30% of forward free cash flow. For oil companies, we like to see this below 40%. Simply Safe Dividends provides a safety score of 90, so this dividend is considered very safe. I mentioned the 110 years of uninterrupted dividends without a reduction, and the dividend has been growing for 34 consecutive years, making Chevron a dividend aristocrat. The dividend is growing at a rate of 4% annually on average over the last 5 years, so the 6% increase announced the other day was a pleasant surprise. Now, we mentioned the $75 billion in buybacks. Now, Chevron has really not been a company that has done this over the last 10 years. See how shares outstanding are mostly flat? So this is a curious time to begin repurchasing shares when they are at all-time highs. Typically, you'd like to see them be smart about this, like, say, a Texas Instruments, who they do a great job of buying their shares back when they're at the good value. Now, the average analyst price target for Chevron is $191.71, representing about 2% upside from current prices. Now, if you're investing in the American oil industry, you're likely either in Chevron here or perhaps ExxonMobil, ticker XOM, another high-quality oil and gas company, which together these make up about 40% of the energy sector's total market cap, at least in the S&P 500, if we were to believe the way the holdings are distributed here in XLE, a sector ETF. And note, this ETF itself is up over 42% in the last year. So yeah, this sector has run up a good bit. I would not be going heavy at this point in time in anything energy. It's a cyclical sector, and better opportunities are ahead. Stock number 3, BlackRock Inc., ticker BLK. On January 25th, 2023, BlackRock Inc. announced a $5 per share quarterly dividend, which is a 2.4% increase from its prior dividend of $4.88. To be completely honest, I was somewhat underwhelmed when I heard this news, as Chevron pulled out 6% raise that same day, and BlackRock has a strong history of raising its dividend, on average 13% over the last 10 years. But a raise is a raise nonetheless, and they also announced a plan to repurchase 7 million of their shares. BlackRock is an investment firm, the world's largest asset manager with $10 trillion in assets under management as of January of 2022. They are one of what is called the Big Three index fund managers, along with Vanguard and State Street. So this gives BlackRock a massive share of ownership in the stock market and by proxy, American business. This makes BlackRock one of the top shareholders for many companies. They are listed as owning 6.34% of Apple and 6.77% of Microsoft. In reality, these shares are owned by and large by individual investors like you and I who invest in the funds managed by BlackRock. But this does give BlackRock considerable voting power in many companies. Shares of BlackRock are down close to 5% over the last year, which is better than the S&P 500, which is down about 10% over the same time frame. That period in October when it was trading in the low 500s was a great opportunity to be buying this one, in my opinion. And remember, guys, find a brokerage with fractional shares like Fidelity or even Robinhood, and that'll allow you to buy into this one regardless of its high stock price. And the stock price means nothing in terms of valuation. BlackRock's PE is trading at 21.7. This is a bit higher than its 5-year average of 18.3. This one has really recovered over the last quarter. Does trade at a premium to the overall financial sector as well at 10.8, but this is a premium for a high-quality company. Shares of BlackRock are currently yielding 2.64%, which is right in line with their 5-year average. But man, just a few short months ago, this was yielding over 3.5%, so this is another one I would say I wouldn't be going heavy on right now at this level. I do dollar cost average from my position, but literally at a rate of a few bucks per week. BlackRock pays a qualified dividend every quarter in the amount of $5 per share every March, June, September, and December for a total annual payout of a nice even $20 annually. Have your shares by March 6th to get your dividend payment on March 23rd. Currently, the dividend makes up 57% of forward earnings and 65% of forward free cash flow. It has gotten a little high. Perhaps that helps explain the slower dividend growth. Still, Simply Safe Dividends sees this as an extremely safe dividend, giving it a safety score of 98, very safe. We have 13 years of consecutive dividend growth and 19 years without a reduction. Dividend growth has been at double-digit rate over the last 5 years on average, so that 2.5% raise is hopefully an outlier. Shares outstanding are on a nice, slow, steady decline over the last decade, going from 174 million shares in 2013, and today there are 152 million. And this is going to go down more in 2023 with the announcement they are purchasing 7 million more shares. Love to see that consistency. The average analyst price target is $807, representing about 6% upside from its current price. I'd personally like to see it go down more this year. Having an asset manager like this in the portfolio makes a lot of sense. They have a very low debt, but do keep in mind, if you invest, they have a beta of 1.29, so it is more volatile than your average stock, especially when you're looking at blue chip dividend stocks like the ones we feature on this channel. So those are the 3 raises I received really just in the last couple days. Many other investors got raises too, and I want to cover real quickly some of those companies real fast. Here they are. First, we have Kimberly-Clark, ticker KMB. Best known for making Kleenex and household paper products, they just announced a 1.7% dividend raise for its 51st consecutive year of dividend growth. Right now, shares are yielding at 3.62%, and Simply Safe Dividends gives us a safety score of 88. Norfolk Southern, ticker NSC, a railroad company in the eastern U.S., just boosted its dividend payment by nearly 9%, marking their 6th straight dividend raise. Right now, shares of NSC are yielding 2.24%. And Simply Safe Dividends gives us a safety score of 86. All right, next we have S&P Global, ticker SPGI. They increased its dividend payment for their 50th year, becoming a dividend king when they raised their dividend payment on January 25th to 90 cents per share for a dividend raise of 5.9%. The current yield of SPGI shares just under 1% with a Simply Safe Dividend safety score of 99. A couple more real quick. We have Elevance Health, ticker ELV, hiked its dividend by 16%, marking its 12th consecutive year of dividend raises. This is another lower yielding stock at 1.18%, but high dividend growth and a secure dividend rated 99 by Simply Safe Dividends. Next, we have Archer's Daniel Midland, ticker ADM. They raised their dividend by 13%, marking 46 years of dividend raises. That 13% was a nice surprise, as their average dividend growth rate over the last 4 years annually has been 4%, and a rock-solid dividend with the Simply Safe Dividend score of 94. And the final one I want to highlight is Charles Schwab with their 14% dividend raise. We're getting a lot of nice double-digit dividend increases. Many of us broker with Charles Schwab. I have my Roth IRA with them. And we all love their ETF, specifically SCHD. This is a secure dividend with the Simply Safe dividend score of 99. And I think this one actually warrants a video for a deeper dive in the future, so do be on the lookout for that. Make sure you're subscribed and hit that notification bell. And thank you so much, folks, for sticking around if you're still here. Also, please be sure to like the video for the algorithm. It really helps me out. Working on bringing you a lot more great content. And be sure you're also following me on Twitter. That's at Div Growth Income. Don't be shy. I love to connect with fellow investors. And I hope you all have a wonderful day. And until next time, keep investing.